Welcome, everyone. I'm Diego Sanchez, COO of HW Media, filling in for Sarah Wheeler while she's on leave. Today, I'm joined by our lead analyst, Logan Mohtashami, who will talk about this morning's incredibly strong jobs report and the implications for future decisions by the Fed. Logan, welcome back to the podcast.
It is great to be here. This is truly a historical week. Part of the HousingWire tracker that we write, we talked about, we're going to have a lot of labor data this coming week. And to me, they've all come in really well because I think the misread that I see today from people is that they see the headline number being really big, but then they go, okay, bond yields went up. That means the Fed has to hike more. No, they don't. Wage growth is cooling down already. The growth rate of inflation is cooling down. What this shows is that you don't need a job loss recession to break inflation. You need the supply and demand balance to work with each other. But if we had wage spiral or breakaway inflation like we saw in the 70s, we wouldn't be having this discussion right now. The 10-year yield would be north of 5%, mortgage rates would be 8 to 10%, inflation would not be cooling down, and wage growth wouldn't be cooling down. We saw two data lines this week that had wage growth cool down. So it is positive in every way. And for myself, who have the 6 recession red flags up, the two things I needed to see to get it like a soft landing is, number one, the growth rate of inflation falls. That's what's happening. Number two, the bond yields fall. They don't rise. That's been happening. So it's positive all the way around. And this really shows you don't have to crash the economy to have the growth rate of inflation fall. So I'm very happy this week.
Let's unpack that a little more, because count me as one of those people who was surprised by the strength of that headline number. Over 500,000 new jobs, amazing, but also was immediately concerned about how the Fed was going to react. So maybe unpack that a little bit more. What's going on here?
Never put too much weight into one jobs report if it's deviating from a trend. You always want to take the trend, and job growth is slowing down from its crazy pace. Of course, a lot of that is just a makeup from COVID, right? You have the initial COVID-19 recovery, which we had in September 2022. Then you have the jobs that are just, we should get these jobs if the economy is just normal. If there was no COVID recession, we're pretty much getting to the point where we should be as part of the longest economic and job expansion in history. So I'm not looking at the headline or the positive revisions that we see as a start of a new trend. I just see what I've always thought would be the case. Massive job openings, when this recovery happens. Jobless claims very low. Baby boomers are retiring or leaving the workforce. So the need for labor is there. But the fact that wage growth is cooling down, it's still positive, but the growth rate is cooling down. The employment cost index that the Federal Reserve tracks always, that came out this last week. It also cooled down, and the labor market is solid. So I think for those of us that have tried to stress, you don't need to destroy the economy to get the growth rate of inflation is down. This is a positive aspect of housing. So I don't think our first initiation or our first reaction should always be, oh, what's the Fed going to do? The things that the Fed are tracking are slowing down. So unless they change the language about that, there's nothing we need to do. Just let the economy take its course, let people have jobs, and move along with it. Get past this fear of the 1970s and needing to destroy the economy to break inflation.
So you see it that way, and I think that's a very insightful way to look at it. Do you think that's the way that the Fed is going to look at this? They raised rates by a quarter point on Wednesday and made some noise about some future hikes. What do you think their next move is going to be?
The Federal Reserve has targeted core personal consumption expenditures. That's the PCE inflation. And they said that they want that down to 2%. How they're looking at the Fed funds rate to get to 5%, and just let it stay there and see what happens. They're not talking about, well, we need to be basically 2% above core PCE, because core PCE, the growth rate is falling. We're going to have a 3 handle. So technically the Fed funds rate, if they were following their own logic, should be lower than what it is today, because the core PCE is slowing down. So the inflation growth rate is falling. We have to get away from this, that a tight labor market creates wage spirals. Well, it's not here yet. So if you're concerned about inflation is that the U.S. economy is booming, too many jobs, too much wages, not enough supply out there, and that spirals out of control. Things that we see during a global pandemic, and the history of global pandemics going back 800 years are very simple. You have major inflationary trends, for 2 years, and then the disinflation happens after. So they told us what they wanted, and to be honest, this is why the 10-year yield's at 3.5%. If we had breakaway inflation, we're much higher today. So what the Fed is looking for is actually occurring. What bearish American citizens, or as I call them, stock traders, they're tripping over themselves, because a lot of these people we were in a recession last January of 2022. So they have to try to, they have to hope that the Fed just raises rates as fast as possible to destroy the housing market, destroy the U.S. economy, to justify their bearish takes out there. But no, I think everything looks about right compared to what the Fed has told us they wanted to see as of now.
Since the Fed did their small rate hike earlier this week, we've watched mortgage rates decline. According to HousingWire's Mortgage Rate Center, rates for 30-year conforming mortgages have dipped into the high fives. Do you think we have a chance to return to a boring and balanced housing market soon?
So here's the crazy action. One of the things I do with the HousingWire tracker is look at that 10-year yield. And for the last few weeks, I've said we're in this Gandalf stage where, Gandalf says, you shall not pass. And we cannot break under 3.42%, close, and get follow through bond buying for some time now. That this has been a tough area to crack. So right now, mortgage rates went from 5.99% to 6.19% today. Bond yields went up, mortgage rates went up on it. But in context to what we've seen since last October, the growth rate of inflation is falling, wage growth is falling, right? So these are the things that the Federal Reserve wants to see, and the bond market has got ahead of the Fed out here. So I don't believe the Fed is going to accelerate higher, because their own tracker, or the things that they're tracking, are basically falling. So unless they come out and say, well, we want to be restrictive because we really, really do want to destroy the economy to make our jobs easier. So we want to go 2% above the core PCE rate on 3, 6, 12 months. So you're looking at maybe 5.5%, 6% Fed funds rate. They're not talking about that. They're talking about just getting rates to about 5%, or wherever they want to get the final 2, and just letting it stay there and let the lagging impact of Fed rate hikes. That's where we're at. This is one of the reasons why I've not been a Fed pivot person. The Fed has told you what they wanted to see until the jobless claims data gets worse. And I've targeted 323,000 on the 4-week moving average of initial claims as the main thing for myself. I did not just randomly pick that number. Where job openings are at and unemployment rates, if we are able to get to that number, the labor market's broken. But until then, they're not going to pivot and cut rates, no matter what the bond market is. If we start to get to that stage, the bond market will get ahead of them. But for now, they're kind of doing what they said they were doing. The bond market is reacting to cooler inflation data, cooler wage growth data. This is Goldilocks, considering that everybody thought we were in a recession last year at this time. So growth rate of inflation falls, bond yields keep on falling. If that trend continues positive, because the one sector in the economy that's in a recession is housing. And we've already seen a bounce from the bottom on some of the demand data lines. And we stabilize and we get a functioning market, and we don't have to be crazy anymore with Fed talk, and let the economy find its way right now, because you don't need to create a job loss recession to defeat inflation, because that eventually impacts production. Like we've seen, housing permits have already fallen. They're going to fall all year long. Luckily, we have that backlog of homes that they have to build. If that wasn't the case, construction labor would already be lost. So we're fortunate in that aspect on the production side.
Looking at the data that we get from our friends at Altos Research, we've seen, like you said before, some signs that demand has bounced off the bottom in a positive direction. Inventory, some small declines. Maybe we'll see some increases in February. Do you think we're going to get to the point where you can take that savagely unhealthy label off of the housing market?
Well, probably the most important housing data line for me in my work in regards to the savagely unhealthy housing market is days on market.
Yep.
Is now no longer a teenager. Days on market, the last NAR report is 26 days. We're so close to getting to that 30-day. We get to 30 days on the market. Half of the savagely unhealthy housing market is gone, right? That was a big thing of mine. Whenever days on market are a teenager or under, nothing good happens in housing. That means you do not have enough product or you have a massive credit boom. We didn't have a massive credit boom in housing, right? We just didn't have enough product. So the days on market growing is on one side. Getting inventory back to 2019 levels, which is something that I forecast on Mike's show last June, is problematic because new listings data started to decline after June. So if people don't list their homes to sell to buy another one, that's a very problematic thing with housing. In this case, people listing their homes in the spring, we always get that spring traditional increase. That's a positive because especially now that rates have stabilized, they're heading lower, but they're stabilizing. They're not having these wild movements. These are all positives for the housing market. And hopefully we get the spring inventory to increase. My call from last year, getting the NAR data back up above 1.52 million, that's going to be extremely difficult now since we broke under 1 million active listings per the NAR data going into the year. But still, we're in a better spot this year than we were last year. Last year was savagely unhealthy, did not like the housing market, said it was the worst housing market ever seen, January, February, March. And we're just trying our way to get balance. And there is more balance now than last year. So I'm happy on all fronts because the labor market is solid. There's no housing credit distress 2008 event that people have been screaming about for 10 years. So this is as good as you could get considering all the variables we've been having to deal with post-COVID. And 3.4% unemployment rate, right? Most people are working. That's a good thing. That's not a negative. That's a positive.
You just got back from freezing cold Texas. You gave a series of speeches to Keller Williams brokers and agents throughout Houston and San Antonio. What insights were you sharing with those audiences? I heard really good things about the speeches.
Yeah, you know what? For me, when I speak at these events, I try to give an entire housing economic scope with charts, so real estate agents and mortgage people can talk to their clients and show them real data. Unfortunately, we live in a society where if it bleeds, it leads, or if it's doomsday, it gets most of the attention. And in that context, that's not how economics is supposed to be. I always say economics done right should be terribly boring, right? It's not designed to be this sexy, hot, fun event, right? It's really gritty, tedious work. So what I do at these events is I show a bunch of broad, different housing, mortgage, economic debt charts, so people could understand the difference between this housing market and the ones we've had, for many decades. It's not just 2008, but it's other cycles as well. And the two things for me always, part of the America's Back recovery model on April 7th, 2020, demographics are much different this time. Household balance sheets are much better. So the need for manual labor will be more now than what we saw back in 2008 and 2012. So the job opening should be high. Check. We've got that. We're over 11 million. We're into 2023 now. There should be no questions about that. And then also, the consumption levels are going to be stable because household balance sheets are stable. Now, eventually over time, higher short-term interest rates, higher credit card interest rates, those things eventually slow down consumption. But for now, this is good. This is good. None of these are negatives. These are positives. The housing market, one of the things that I stress at these events is we just had a waterfall dive in demand. in housing. Took us all the way down to 2007 levels. And everybody said, well, if sales collapse like that, inventory will go up 3, 4, 5 million. We broke a million. We had the waterfall dive that everybody told us. Once that happens, 2008 all over again. Not the case. But it's not having that final number. It's showing you why. And this started all the way back in 2005 with the bankruptcy reform laws, in 2010, the QM laws, and showing people progression models and economic data easy enough for them to tell their clients, here it is, right? This is the reality of where the world is. And this is why I love showing that 4-decade chart of total active listings, where you can see we had more inventory in the 80s and 90s and 2000, but now we have over 350 or 330 million people in America. We have over 155 million people working. We have 3.4% unemployment rates, and the active listings going into January of 2023 is 970,000 per the NAR data per Atlas Research. Mike, we're at 465,000 for single family. Yeah, that is not a good thing because there's not enough product there. We paid the price with massive housing inflation during COVID, but we're trying to find a way to get some balance. And I'm very happy to see the days on market growing.
I think the housing professional really appreciates the way you break down the data and you move past the headlines, which can be very gloom and doom. We try to avoid that at HousingWire, but I think the way that you break down your analysis is very helpful to that housing professional. And just to remind the audience, if you want to have Logan come and speak at one of your events, send an email to press@hwmedia.com and our team will help you out and figure it out for you.
And there's a reason why I challenge people to live debates, because if I could get people in live debates, you could see the difference between a housing data analyst and the other side, right? And if you don't have models or anything to work with, or you don't forecast anything for 10 or 12 years, you just throw stuff up in the air. It's really evident. And for the most part, most people don't even attempt to debate me on a live debate. But if that occurs, I can show the difference between people who forecast and have a model versus people who really, really highlight what we are taking advantage of, the doom and gloom. And recessions come and go. I've always said there people that might say there's a permanent expansion cycle. No, recessions come and go, but majority of people are always working. We just came off the longest economic and job expansion ever recorded in history. We had a global pandemic. We had a 6-week recession. We recovered from that high. And here we are today in February of 2023, basically 3.4% unemployment rate, right? And not an economy that's collapsing.
So if you want to debate Logan, you can send an email directly to me, Diego@hwmedia.com, Diego@hwmedia.com. I'll be very happy to facilitate that debate. So we're recording a housing market update next week that you'll be joining and presenting your 2023 forecast, and also joining a panel of some very distinguished economists and housing market forecasters to talk about those findings. What are you going to share with the audience on Monday?
Well, here I'm really going to just talk about the updated tracker every week, and the tracker is something that, in a sense, I've done for myself, because I believe forward-looking housing data has always worked since the 1990s, and that the housing market was actually getting better starting November 9th, and November, December, nobody wanted to talk about it. Personally, because I don't believe people know how to read the data correctly, but we're now seeing it in the pending home sales data, existing home sales. We've seen a bounce in some of the things. And just always to make context critical, we had such a waterfall dive in demand, and we've just had the stopping of the bleeding and a bounce from there. And then we track this weekly to see, can this continue? Do we need 5% mortgage rates to have it grow, or does 6% mortgage rates keep this going? Or is the stabilization good enough to where demand picks up by itself a little bit, and then the builders can get all their excess supply out? I think one of the questions I got in Texas is, man, the builder stocks are 52-week highs. What's going on? And trying to explain that. Does anybody know how many new homes active listings we have in America today? And nobody guessed, 71,000. That's not a lot, right? Because the builders traditionally have between 80 to 120,000. So the whole business model of the builders had to be explained. So there's a lot of things that go into housing economics, but the fundamental is it's demographics and affordability. That's it, right? And then you go to credit channels. Credit channels are normal, boring, stable. There are 30-day delinquencies. Everything is so low because the U.S. consumer, and that's a big part of all my presentations, on paper have never looked better. This is something that has never been given credit for the last 12 years because stock traders and professional troll artists do not know credit channel risk because they have no trading. And you could see this by the things they've said constantly for the last 12 years. They don't have the sophistication to know what they were saying were wrong for a very long time. And let February of 2023 show that to be the case, because if it wasn't for COVID, we'd still be having the longest economic and job expansion recorded in history.
I'm excited about the housing market update. We'll put a link to the registration page in the show notes. We already have over 800 people registered, so there should be a lot of audience engagement. Logan, thank you so much for joining me today. It's always a pleasure. Look forward to having you on next week.
Pleasure. Have a good weekend.